Hey everyone, you are tuning into In the Money with Amber Kanwar. If you want to learn about technical analysis, what does a chart say about where the stock can go? This is the episode for you, whether you know nothing about technical analysis or you know everything about technical analysis. We are going to cover it all. We'll go through the basics, and then, as always, we go through a bunch of different stocks that are showing some buy signals and even a few that are showing some sell signals. And a reminder that all this month we are doing our swag giveaway. It is so easy. Easier than technical analysis, that's for sure. All you have to do is be a subscriber and comment under the videos, and we will pick you. Well, we might pick you. I don't have an unlimited supply of things to give away, but you have a chance to win some of our swag, like our signature In the Money hats that are flying like hotcakes. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Katie Stockton, thank you so much for joining me on the podcast.
Of course, great to be with you, Amber.
I tried to do some market research to see if there were a lot of shows, podcasts about technical analysis, and I found one actually in March, and guess who the guest was? It was you.
Could only imagine. Well, that's good. I'm glad it's out there.
So we know that you can do technical analysis for a podcast. And a lot of our investors, they're sophisticated, they're in the markets, but still, I think it's worth doing just a basics. What is technical analysis? Because it's very different from fundamental analysis, right? When you're trying to understand what does a company do? How much is it going to earn? What is the essence of technical analysis and what it's used for?
Yeah, of course. It's great to start with the basics. Technical analysis is essentially the study of price trends, which of course are a reflection of the supply and demand for various securities. And it can be applied to any asset class. It can be applied to any time frame. And that's really the beauty of it. It's mathematically based using price-based indicators, technical indicators, that measure things like momentum, overbought, oversold inputs, relative performance. And it's through the use of these technical indicators, including things as simple as a moving average, that we can understand the supply and demand dynamics for various securities. We often apply it in our research to the stock market, of course. So we are looking at companies as stocks rather than companies as companies in a way. So to differentiate it from fundamental research in that we're not looking at balance sheets or we're not trying to understand the management team's take on things. We're really just concerned about the price action in the stock. And that's essential. And I think it's essential for multiple reasons. One is risk management. We obviously want to keep trends on our side. We want to buy stocks that are either in uptrends or likely to shift into uptrends, and we want to sell those that are breaking down. We also want to use it for market timing, so trying to understand if we're having a good entry or exit point within the scope of the trend. Is the stock extremely overbought or overextended perhaps? Well, then maybe it makes sense to wait for that pullback. So that market timing input is essential as well. And of course, we're always looking for opportunities to generate alpha. So we're looking for relative return. We're looking for setups that are high probability and what we call technical catalysts. We all know about fundamental and macro catalysts, of which the FOMC meeting is a great example of a macro catalyst. A fundamental catalyst might be something like a drug approval for a biotech stock. For technicals, it would be a breakout on a chart. So a stock or security that has cleared a resistance level, an area that it had stopped out at before, or something like a crossover in the moving averages or a buy signal or bullish crossover in some of our indicators. Those are the things that we're looking for when we're evaluating the charts.
I love that example. And I also love how you explained kind of all the different things that it's used for. And people can look at, there's so much terminology that gets thrown around. And I feel like it really is just a study of behavior. At what point do buyers step in? At what point are buyers exhausted? And I'm always amazed time and time again when I speak to a technician, you look at a chart and you think, oh, okay, this is when I know the drug was approved, or this is when I know the trial didn't go well. But the magnitude of the decline or the magnitude of the upside can often be governed by technicals. So it's not like a separate thing to fundamentals. Is that kind of a way of thinking about it? It's kind of how the fundamentals are expressed in a chart.
That's right. Yeah, I think that's very well put in terms of the governance that comes from the charts. So when you think about technical analysis, looking at something like a 200-day moving average, which is pretty understandable to everyone. It's, a good gauge of the primary long-term trend. It often acts as support and resistance. The 200-day moving average is not predictive, though, right? It's not going to give us a sense of, what might happen next necessarily. But it is an important input in part because a lot of eyes are on it. So maybe there's even a self-fulfilling element to it. But these things are a reflection of the trending nature of markets and various securities. So, and then the trends are a byproduct of the supply and demand that comes from the fundamentals or comes from the macro take. So every sort of decision out there boils down into either a buy or a sell order, right? So it's assuming that the information that's available to investors has already been baked into that stock chart or that sort of commodity price trend. And that way you can see are buyers bidding up, that security. So you can really get a sense of the behavioral elements of the market through simply the analysis of price. And what I really love about technical analysis for those that are a little bit more mathematically inclined, perhaps, or those who like the more binary outcomes, it does get you sometimes to that very binary takeaway of buy or sell or positive or negative. Whereas other, disciplines might be a little bit more subjective. It really refines it into a very clear mathematical conclusion. So some people might push back and say, oh, well, technical analysis doesn't work. That doesn't even really make sense, frankly. It's more, human error, if anything, or whoever's using that discipline and how they're employing it. Well, that's where the mistakes come in. It's not the discipline itself.
I'm glad that you brought up, sometimes people say technical analysis doesn't work. In my sort of 15-year career, I've had a lot of people be pretty dismissive of technical analysis. And I'm curious, you've been in this career for a very long time, how you've seen technical analysis evolve when it comes to the role it plays in decision making. Does it just continue to get bigger and bigger? What has that been like over your career arc?
Yeah, for sure. It's been much more widely adopted by investors over the last, I'd say, more than 10 years, really since 2008. I would say it was a turning point for technical analysis and its uptake, in that when the markets went through such a huge downturn, and it really became evident how important risk management is to preserving capital and to wealth. That's when people were looking for alternatives to other disciplines that really didn't give them either any heads up or didn't get them out in time to miss just the bulk of that downdraft. technical analysts really got a good name at that point where they were more helpful in terms of managing risk, I would say. And so with that turning point, I do feel like the uptake is definitely greater amongst investors, and that goes for Wall Street and also Main Street. And then we have such better access to information and to charts and to these indicators that we used to have to calculate ourselves in some cases. So that access to information combined with a couple of big bear market cycles has really elevated the discipline and made it so much more accessible to the average investor.
Okay, so that's super interesting. I didn't realize that 2008 was such a turning point. I want to talk about the markets. I can't wait to talk about the markets. But one thing we got a lot of questions on, even before we go into the mailbag, everybody wants to know, like, what's a DIY way to do technical analysis? What are your favorite predictive indicators, and how can people learn more about that stuff?
There's really no one easy answer to that question, and that there's so many different ways to approach the discipline. And I developed my methodology, which consists of, I'd say, probably 5 or 6 indicators that are my go-tos. I just developed it under different mentors, sort of adopting what they had brought to at the table in terms of momentum and trend following, overbought or oversold inputs, relative performance. Those are to me the 3 main inputs that we're trying to understand. So I think if the sort of end user has indicators that can help them do just that, identify trends, identify whether those trends might be overstretched over different time frames, and then also have a way to understand relative performance, I think that's the best goal. And there are so many ways to get about that. We like things like the MACD indicator, or MACD. It stands for Moving Average Convergence Divergence. It's very, very common technical indicator that's derived from exponential moving averages of price. We also like the
And what does
stochastic
that tell
oscillator
you?
as one.
What does it tell you?
Well, you mean right now about the markets,
No,
or?
like in general, like what's the information you get from the MACD
That would
indicator?
be, yeah. We call it momentum, either price momentum or as a trend following input. Both are pretty valid. So if the MACD has a bullish crossover, we tend to say it's either improving or positive momentum behind that move. Like many technical indicators, the MACD is lagging. So it's going to have a smoothing element to it that actually makes it late in its signals. And while some might see that as a drawback, we actually see it as more confirmation of important turning points. So that would be one nuance to impart. And there's also criticism, I would say, out there about technical analysis as using these lagging indicators. Well, I would sort of challenge those folks to find me a discipline that doesn't have sort of historical data as their primary input. But we do have some indicators that are more coincident. The DeMark indicators, for one, are Tom DeMark's third-party service. We love those for helping us understand if something's overdone one way or the other, sort of a counter trend indication. The stochastic oscillator also helps us get close to that answer. At times, it tells us if the trend might be overstretched. And then for relative performance, we're primarily using ratios. All of these indicators and then some can be generally accessed online and really for either very low cost or even free. I know TradingView, for one, which I have no affiliation to, has great charts that are pretty flexible at a low price, if not free. And so there's so many tools like that online, and so many great third-party services that can help the novice technician learn and employ it on a regular basis.
And you've been kind enough to offer a free trial to your own research to help people, try and get their head around it. So I encourage people to check that out. If you're interested in technical analysis, fairleadstrategies.com/trial. And of course, that link is in our show notes as well if you're interested. Okay, that's a great primer. Can we please talk about the markets now? The S&P 500, all-time high after all-time high. There's the headlines, and then there's what the market does. The headlines are negative, and then the market just keeps climbing higher. So let's tune out that fundamental noise and just look at what is that telling you about the behavior and the longevity of the rally.
It's been pretty remarkable, hasn't it? Just off of the April low for the S&P 500 and really most sort of major equity indices around the world, they've hardly looked back. The pullbacks have been days, not weeks in duration. And with that, the momentum gauges point higher. I can't think of a market around the world that it has very weak long-term momentum at this time. So we have S&P 500 at new all-time highs, NASDAQ 100, even the small cap Russell 2000, which has been a source of long-term underperformance, is on the verge of new all-time highs. So these are bullish long-term takeaways, and the uptrends are still supported by positive long-term momentum. To arrive at that conclusion, we are not just saying, oh, it looks like it's strong. It is from those technical indicators. So we have these takeaways that are we impart through our commentary and our research, but it's all very mathematically based. So when we say positive momentum, it's a measurable feature of these price trends. So when we're looking at monthly data on the monthly bar charts, we do have positive momentum. If you hone in on certain environments, it's a more neutral short-term takeaway. Looking at the daily charts, the daily charts still have upside momentum, but we do have some minor signs of upside exhaustion that come from those other tools that measure overbought, oversold inputs. So we're more neutral from a short-term perspective, noting also that the volatility index, which is a measure of market sentiment, which is another input. It's more of a tertiary input for us. It comes after price analysis, but sentiment looks like it's a bit complacent. And we, of course, have seasonal influences that aren't great this time of year. So we are looking for some kind of volatility pickup with the VIX having climbed above its 50-day moving average, just as an impetus for that. And yet we are not yet recommending hedges because we're watching simple metrics, even like the 20-day moving average. And it's really hard to find a market that doesn't have the support of the rising 20-day moving average. That goes for the TSX as well.
And we're going to talk about the TSX. Let's stick with the US for a moment, because you know as well as I, people who are fundamental based, they look at valuations. There's a lot of bubble talk out there. What I find interesting is that the markets can turn over inside of itself, right? Like it can switch leadership from the Mag 7 to everything else. And it seems like that handoff has taken place since August. The Mag 7, yeah, fine, they're still hitting all-time highs, but maybe on a percentage basis, you're seeing bigger outperformance from areas like gold. What does that churn tell you? The internal churn, is that a sign of strength? You mentioned the word exhaustion as well. I think people try to understand, people say things like all-time highs beget all-time highs until they don't, right? Like, what is the technical anatomy of a bubble and signs that it's ready to tip over or ready to pop?
Yeah, of course. I mean, people are reasonably talking about that. I mean, we had the AIQ ETF, which is a good benchmark for the AI trade, up about 7% just in the past couple of weeks. So we're seeing these pretty massive gains that you can't help but hearken back to maybe the dot-com bubble and recall the same types of gains. Although to me, it felt like a bit of a different environment then. It was more parabolic than what we have now, even though what we have now is quite steep. So when you see the loss of leadership from segments that have exhibited leadership like AI, well, that becomes typically problematic. It used to be all about semiconductors. Semiconductors, if they lost their leadership stronghold and started to underperform, that would be a big setback for the market. Now I think it's more AI, which does, of course, include some semiconductor stocks. And so if we see a pullback develop there, well, that might be enough to shake the confidence in the market from a group level sort of input. The Mag 7 are still key because they have such a huge footprint, and you could even expand that now. Oracle, Broadcom, and a couple others, maybe Berkshire. So these big heavyweights in the market are always going to be important to the major indices. Now, if they're rallying and you're not overexposed to them, well, tends to be that you're underperforming the S&P 500. And in that sense, it's been a pretty difficult tape for many investors because they can't assume the concentration risk of being in these mega caps, and yet they feel they're missing out on some of these massive gains, like we've just seen from Alphabet, from Oracle, even from Tesla most recently. So it's a challenge, but we would just caution against getting too concentrated because the environment is, always changing. And as much as we've had such a persistent uptrend and such persistent leadership from certain segments, the market is cyclical, and so is group rotation. So there will be a point at which that concentration becomes detrimental. For now, though, the Mag 7 and the AI trade largely looks positive, intermediate to long term. We do have breakouts there. Tesla and Alphabet are the most recent breakouts that I would highlight. And those are breakouts to me that are bullish from an intermediate term perspective. And yet, you could certainly make the case that things are a bit overdone from a short term perspective. And again, when I say that, that's more of a measurable takeaway from our indicators as opposed to just an opinion based on how steep the up move has been.
I want to double click on that comparison that you made a few minutes ago about the dot-com era and what we're seeing right now. Because you're so technical and mathematically based, what are parallels and what's kind of different this time from a technical perspective?
Yeah, I mean, I think the parallels, if anything, probably don't come from technical analysis. I think they more likely come from fundamental research, folks that are looking at valuations. If there is a similarity, it would just be the tech sector leadership and the fact that it is driven by a very exciting, I don't know if you can really call it a new technology, but then it was internet, now it's AI. It has that similar feel to it in that regard, but that's more of a fundamental takeaway. On the charts, we have not an environment that's quite as parabolic. So if you do a side by side, you might find some charts that look that way, certainly. But on a broad basis, to me, it doesn't have the same feel. I used to go into the office every day, and it was almost a guarantee. It felt like that some of these key players in the internet or .com world were up 3-4% every day. It just felt like they really never looked back. And as much as it's been a very strong uptrend, it doesn't have that same feel to it as it did back then, where it was really very parabolic. A lot of gaps on the charts, too. If you went back to look at some of these individual stocks, there would be gaps after gaps after gaps. And we don't have that kind of gappiness, even from the more high flying names within the market right now.
What do meme stocks do for you as a technical analyst? Like, can you see a meme stock coming? Because I look at that and it's like, where's the hint? One day it's down 80% because it's this kind of garbage stock and company. And then, somebody on social media gets involved and then it just goes parabolic. That's kind of a newish phenomenon, right, over your career. So can you still apply those same principles of technical analysis to meme stocks?
Yeah, I think you can. Anything that has a price and that has some liquidity, you can certainly apply the indicators. But when something is exceptionally high beta, or if it's really gappy on the chart, or if it has a binary fundamental event that you're trading it for, well, then you have to be very wary of that, right? So, and sometimes your support and resistance levels that we use to try to understand risk reward relationships for trades, well, they can be really far off, right? And that could be almost a risk metric for you. And you can't make these things up. Let's say something's overstretched in a way that it's, dozens of percentage points away from its 50-day moving average. Well, that is just by the nature of that distance to the 50-day a risk metric. So, in a way, technical analysis is even more important when you have that kind of high flying probability. But the way we here at Fairlead think about meme stocks is more from a sentiment perspective. So when we have that kind of speculative environment where there's people betting on the direction of these stocks that you could argue are not great quality, well, that's interesting to us more from a read on market sentiment, because it shows that it's like another transactional gauge. It shows a willingness on the part of retail to chase. And that can be, in a way, contrarian as a takeaway.
So what's it giving off right now? Is it as like exciting as it was in 2021, or is it just like kind of little fits and starts?
Yeah, the fits and starts is a good way to put it, because we have seen it manifest itself at various times, and it becomes more of a short-term indication of sentiment at that time. But in terms of the consistency of it, it doesn't seem to be there. But we still value that input from the market. But we do discourage our clients from investing, by just chasing these meme stocks. It is a very dicey proposition.
All right. And a reminder, Katie is offering a free trial to her research. You can find that at fairleadstrategies.com/trial. Let's step into the mailbag, Katie, because we got a lot of questions. Okay, our first question, of course, we're a Canadian podcast. So our first question is about the TSX. Arnie wants to know, what do you see with the TSX? Will it continue to set records? It is setting records. It's outperforming the US markets. Technically, what does it look like for the TSX, Katie?
Well, I'm probably not going to add a huge amount of value here with that question, but I would say just respect the momentum. So it's an intermediate term uptrend, it's a long term uptrend, it's even a short term uptrend. So no matter what time frame you're evaluating there, the uptrend is very much the dominant feature on the chart of the TSX. The outperformance may or may not be sustainable. It could be in part based on the exposure to perhaps the gold miners. And yet we would just respect it while it's happening. And what we're doing with these kind of steep uptrends here in the US is by just evaluating those 20-day moving averages as a short, pretty tight moving average, but a good way to understand when the market has entered a pullback or consolidation phase that might warrant risk management. So as soon as we see the TSX lose the support of that uptrending 20-day moving average, that would be your first indication that, okay, well, we're in store for more than a pullback that lasts just a few days as what we've become accustomed to.
What do you make of, like, the TSX is, gold is a part of it, and that's actually our next question, but the TSX outperforming is also part of this phenomenon of international markets doing better than the US markets. And over the last 10, 15 years, that's exceptionally rare. The US has been, it's been USA all the way. The dominance that the US has in global benchmarks is huge. What is that telling you? The fact that international markets are outperforming. So yes, US markets are at all-time highs, and that's great. But on a percentage basis, you're seeing a bigger re-rating elsewhere.
Yeah, it's been really interesting and definitely a shift that I feel is notable. I think it's too early to suggest that we have a long-term reversal in trend and relative performance, US versus international, but it certainly seems that we're in more of a balanced environment as of the start of this year. And you'll note that the relative performance generally for international markets versus US started improving as the US pulled back, right? Or got into a pretty big corrective phase, right? So it was almost a lack of confidence in the US that then benefited the relative performance of the international market. So we'd expect maybe more of the same if we see a correction unfold in US, then that international outperformance may become even more pronounced. The ratios that we evaluate for relative performance long term, there's still secular downtrends, international versus US. And yet, those downtrends, we would say, have lost downside momentum. And that puts us in this potentially more balanced environment. And we're always using country level relative performance as an input. And you can find some great opportunities on the country level that, would be sort of something you'd equate to looking at different sectors of the market. You can find some low hanging fruit in terms of relative performance there.
You mentioned one of the reasons that the TSX has done so well is gold, and that is a big part of our index. And we have a question about the technicals between gold, the commodity, and gold stocks. What is a better setup from here? This question coming from KMAC on Instagram. And it's so interesting because gold, obviously bullion started to run first, and it took a hot minute for those gold stocks to catch up to that, and now they're outperforming. Talk to me about that dynamic and what you see going forward.
Well, it was pretty interesting in that we were fielding a lot of calls about the miners, and that's not normal for us. We're usually fielding a lot of calls about software stocks, right? So we found it pretty interesting that this momentum push really instilled greater interest. So, and I think just I don't know if it's a market psychology takeaway, but people tend to go to the stocks as opposed to the commodity in terms of investable sort of ways to leverage that move. So, they're looking for new mining type of positions or Barrick Gold, and yet investing in the commodity might seem a bit more mysterious to them. So, I think some of that performance simply comes from that, and the prospects that the higher gold prices will, of course, carry over to their fundamentals. Indeed, the trends are still very much positive for gold itself, for the gold miners. We have our first sign of short-term upside exhaustion as of really yesterday for the price of gold. That's, I guess, 2 days ago from when this is published. And yet that would be just a minor indication supporting consolidation as a pause to refresh. The price of gold had been range bound for, I think it was about 3 months or so. And when it advanced from that range, that acted as a nice technical catalyst. So that was one of those catalysts that we like to see on the charts. And it happened after support was discovered multiple times at a key level for gold. So we're pretty constructive on both.
Do you dare to put targets around where you think gold bullion can go?
Yeah, I mean, we had from our last breakout, from that range breakout, a measured move price objective that we could arrive at. And what that assumes is I'd say the trajectory of the primary trend, which of course is higher for gold, would maintain itself. And it could get gold to about 37.60 per ounce based on the generic futures. And now that level seemed much more aggressive when we first assigned it. Now it seems pretty achievable, and not in more than a few weeks even potentially. So we'll ultimately have to try to revise to a more aggressive upside objective, but that's the best we could come up with based on the recent breakout. And this is always a challenge, by the way, when you have so many markets and securities at new all-time highs. Well, that removes the chart's resistance, and it removes a way for us to understand where that uptrend might run into resistance or meet sellers. So 37.60 is what we could get to.
All right, so 2%, and then you'll have to reevaluate where it goes from there. Uranium is, we got a question on uranium from Kurian in Brampton. Could you please go through the technicals on uranium? I'm considering buying a uranium ETF. And here too, there's a physical uranium ETFs, and then there are the uranium companies. Talk to me about both, which looks better right now.
Yeah, no, of course. And it's a great point that there are now products out there that make it so much easier to invest in the commodities for individual investors. So there's ETFs. I think there's URNM is the uranium miners, or URA might also have exposure to the miners. The physical trust that we use, it's a Sprott Physical Uranium Trust. And that, I don't know if you call it an ETF, but that fund has a new catalyst. And it's actually something that we highlighted in our research last week. So it was a technical catalyst that lifted the fund above some key resistance that we watch. We have one of our metrics called the cloud model, and the cloud is a way to gauge primary trend inputs and then also support and resistance. And that cloud was surmounted by this Sprott Uranium Trust. So we have a positive catalyst there for higher uranium prices, at least over the intermediate term. And the long-term trend seems to have turned the corner there as well. The miners have, I think, anticipated this to some degree. So in the same way that you're seeing really bullish action in the gold miners and silver miners, almost to the extent that it's not as justified based on the prices of the commodities, I think you have something similar happening in the uranium miners. But that complex has very strong momentum, strong relative performance. I looked at both URA and URNM earlier today, and I did notice that there's some minor signs of upside exhaustion on the weekly chart that would suggest for a few weeks, perhaps, they're more likely to consolidate, meaning sideways to lower, but still within the scope of their long-term uptrends.
All right. So something to put on the radar, maybe uranium, the physical uranium due for a catch up. You mentioned silver. What a chart. Big explosive move to the upside. I won't spend too much time on it, but bullish, continue to be bullish on silver.
Yeah, I mean, it had its own positive catalyst, not really of the same nature as gold, but a very short term breakout within the context of its long term uptrend. And the monthly momentum is there as well. So we're constructive on silver, and we always are on board with diversification. So as not to get too concentrated, perhaps, in one of the commodity related plays, we're glad to have a lot of opportunity out there.
We got a question from Bob in Richmond Hill about the Spiders S&P Biotech ETF, and this one's actually on my radar as well. I saw a note from the folks at Bespoke Investment Group. I love their research, and they mentioned, so we're going to get these rate cuts. What are sectors that tend to do well if we get rate cuts? It's biotechs, it's home builders, and the biotechs have been kind of this like sideways trader for like 2-3 years. And I wonder, what does a technical setup look like if fundamentally, rate cuts are helpful?
Yeah, I mean, listen, for biotech, we've had what we think is a pretty long-term low established by ETFs like XBI, like IBB, and we're encouraged by that. The intermediate term uptrend that occurred over the past few months still does have upside momentum, but shows some upside exhaustion, as you could maybe imagine after such a good run. So we feel like the time to buy was not right now, but a few months ago. In terms of finding a good higher probability entry point. It doesn't mean that there aren't individual stocks that look compelling at current levels, but we'd really like to see some consolidation also from the biotech sector so that these gains are digested and therein also the overbought conditions are relieved to some degree, because biotech as a sector is range bound from a long-term perspective. So it's not the same strong long-term uptrend that many other sectors have benefited from, but rather a bit more of a range-bound environment. And in that context, we're going to scrutinize any kind of overbought indications to a greater degree. And with that in mind, we don't feel like it's the best level to add exposure. But certainly if a position is working, maybe that position has the support of a rising 20-day moving average, that's a good thing. We would just stay with those existing positions.
With the markets at all-time highs, people try and get cute, like me, who tries to buy stocks maybe at a multi-year low. Everything's going up. I'm going to find what's going down. And we got a question about Lululemon, which, trading at the lowest level since March 2020, doesn't look like it's found a floor yet. But maybe we can use Lulu as people do love to bottom feed and they love to find value. Like, when does a chart like a Lulu trigger a signal that yes, the selling is done?
I mean, that's like the key question, isn't it? But this is where the charts can really be very handy. I think when you think about a value investor or somebody who is inclined to buy into those downtrends, I think they'd benefit incredibly from technical analysis, even though it's not usually associated with the same. It's usually associated with growth and momentum. But in reality, it can measure downside momentum and how strong it is. So Lululemon still does have strong downside momentum. What we like to see to suggest that it has found a footing is simply sideways action. We call it stabilization or support discovery, something more than just sort of not a straight line, but a 45-degree angle lower on the chart. We want to see that support discovery, which then, of course, will manifest itself in the downside momentum gauges, showing less downside momentum. We do have our DeMark indicators as one way to understand in real time if something is overdone on the downside. So if there is a signal from the DeMark indicators that would suggest that there's a counter trend low or high being established. Well, then we're going to, certainly use that as one of our inputs. But it's important to note that we're not using any one indicator to make our decisions. We're using multiple indicators, and we're weighting them in our minds, in different ways in different environments. So for something like Lulu, where you have a proper downtrend in place and it still has downside momentum, well, if we were to see a big buy signal from the DeMark indicators or from our overbought, oversold metrics, we still might wait to see momentum shift to enough of a degree to convince us that it's something that's tradable on the upside, and tradable on the upside with a reasonable amount of risk that you're undertaking. The other good thing about charts is that they can help us discern a good level below which to put a stop loss or above which for a short position by identifying the support and resistance levels that have mattered in the past. So let's say, a stock had a support level, took it out. Well, that would be a natural place for a stop loss to be triggered, as opposed to just simply, referring to a percentage or something of that nature. So for risk management purposes, especially if you're taking counter trend trades, I think it's a great input.
I love what you said, is it trading sideways after a sell-off? Because that actually flows nicely into our last question in the mailbag about UnitedHealth. It had that awful kind of 45-degree angle drop off, but then for months it started to trade sideways. And if you kind of caught it at the right time, you've made a bit of money. Is UnitedHealth showing those signs of stabilization that you like to look before you say now's the time to step in?
It was at a time. We even published a chart of UNH for our clients and customers through CNBC Pro. We do a weekly article for CNBC Pro. And UNH did qualify as having one of these counter trend signals, but it was only a short term signal. And it was pretty darn close to when it gapped down. And we saw what we felt like was good stabilization on the back of that. But the related longer term gauges didn't improve enough to us to suggest that a long term low has been established. So we're really not convinced of that yet from UNH, because not only did it exhibit downside momentum during that downdraft, but it also took out some key support levels. And we just haven't seen enough improvement in those longer term monthly indicators to suggest that a big low is in place already. So we're somewhat skeptical on the staying power of either the relief rally or for additional stabilization. And we just make sure, if you have a long position with that in mind, to have a stop loss, right? To have some way to manage risk in the event that we do see downside follow through.
All right. Well, you're talking right at me because I did buy some. So I guess I better establish that stop loss. But you talked a lot about positions that a few months ago triggered good buys. So what we're going to do now is get to your pro picks and find out which stocks right now are triggering good buys. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, let's get into your pro picks. Actually, you brought 2 buy signals and 1 sell signal, which I think makes it extra spicy for us on In the Money. Your first buy signal is Apple. And that's fascinating because fundamentally, so many bearish things have been written about Apple. Where is your AI? And you like it. The technicals look good. Explain why.
Well, Apple did underperform for a long time. And in a way, in doing so, it didn't get as overbought relative to the other Mag 7. So if you feel like maybe your position in Alphabet is a little overdone on the upside, you don't get that same feeling from Apple's chart. So if you do believe in the company, we do have a positive technical catalyst in the form of a breakout. It was a breakout that took the stock above former resistance, which was around 215 to 217. It also got through the 200-day moving average as part of its recovery. So we've seen a couple of resistance levels cleared with this recovery. And the corrective phase that it underwent was not a bearish reversal by our long-term metrics, but something that, sort of brought it into some key long-term support. So we feel that Apple, especially among the mega cap stocks, has more upside potential intermediate term and perhaps also long term, just to respect that prevailing long term trend. And we like the catalyst of the breakout.
What kind of upside do you see? Do you have a target there?
We don't assign price targets. We just look for next resistance levels. So I think Apple certainly could reach new all time highs. I don't see why that wouldn't be the case based on the indicators right now. We don't have any sell signals to suggest otherwise. And then it becomes a matter of keeping the trends on your side. So as opposed to having a crystal ball and knowing where Apple will be trading at year end, we wish we did. Rather, we just want to keep the momentum gauges positive.
All right. Your next idea here is Blackstone. And I find that really interesting at a time where financials in general are doing pretty well. But when you look at the chart of Blackstone, it's definitely picked up, but it hasn't really participated to the full extent of the broad financials. How do you think about what's going on at Blackstone right now and what the chart looks like?
And you're picking up on a theme there in a way, Amber, in terms of the fact that it hasn't been a huge source of relative performance means also that it's not quite as overbought in its appearance. So that this is a tough market to find stocks that haven't had incredibly steep and prolonged up moves. So for those that are, out there and somewhat uncomfortable buying into those like very steep uptrends, we like to find names like Blackstone that have new positive catalysts to act upon. So for that stock, it cleared some short-term resistance. It has a short-term breakout. It also has renewed long-term momentum. So not just long-term upside momentum, but sort of a momentum buy signal on a monthly basis that suggests that it can also lift to new all-time highs. So we're encouraged by the fact that it has that positive technical catalyst. It's within the scope of the long-term uptrend that has renewed momentum. And it also follows what was a successful test of some support right around the 50-day moving average and based on our cloud model.
Your third one is a sell signal that was triggered, and it's on Visa. And I think this is so fascinating because I can't think of stocks that kind of both growth and value can agree on. Like Visa is just such a well-loved stock on the street, and for good reason. It tends to outperform when the market is up. It tends to not go down as much, maybe when the market is going down. But this year, it has wobbled a little bit on some fundamentally negative headlines. So is that showing up in some breakdowns technically?
Yeah, I wouldn't say we have a decisive breakdown necessarily from Visa, but if you just zoom out and look at a weekly bar chart, you will see what looks like a toppy setup. So, not to oversimplify, but as it's been more range bound, we have a lower high in place and it looks somewhat distributive because we know, of course, that the market's been making higher highs. So that would be a negative differentiator for Visa, but also that last high generated one of those counter trend signals, a sell signal effectively that would suggest that the up move is overdone from an intermediate term perspective. And then you could even make the case that from a longer term perspective, that it has a bit of an overbought downturn to suggest that it is indeed in a topping formation. And maybe it's only an intermediate term setback for Visa. Maybe the secular uptrend can resume on the back of that. But it does stand out to us as one that's more vulnerable to additional underperformance.
So Sometimes I know people use like, where's support for this stock? If a stock's going to pull back, what level is it likely to pull back to? Do you have that for Visa? Kind of what is its level of support? Right now it's trading at around $340 per share. So what kind of downside support would it have?
Yeah, I mean, right now it's sitting right on top of its rising 200-day moving average. That is roughly 340, and secondary support is around 310 based on our cloud model. So it's not to say that will act as a magnet necessarily, but it does help us frame what potential downside risk might be for a correction, assuming that the 200-day moving average is vulnerable. We always look at these support levels as cushions as opposed to precise points I would keep in mind. So when we're looking for a breakdown, we're usually looking for more than just a day or two below a level, more like a week or two if it's a really key level. So those are the levels that we'll be watching here for Visa. The 200-day we do think is in jeopardy.
Katie, thank you so much for joining us. It's a complicated topic, but you made it super accessible for our audience with a lot of actionable ideas. Thanks so much for joining me.
Of course, great to hear. Thank you.
That's Katie Stockton joining us of Fairlead Strategies. Make sure you tune into our next episode. We are talking about Canadian real estate stocks. They've actually had a pretty nice run from the April lows. They're up about 20%. One of the longest time investors in Canada, Jeffrey Olin, will be our guest of Vision Capital. If you've got questions on rates or real estate in general, you can submit those questions at inthemoneypod.com, and we'll see you on the next episode.